Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Microsoft and Meta shares surge in after-hours trade after results beat estimates and guidance reassures. Apple and Amazon report today and Nasdaq futures climb. Donald Trump asks for a pass on GDP data. The world's largest economy contracted at the start of the year, but the president says it was still Biden's economy then. Plus, the Bank of Japan cuts its growth outlook and keeps rates unchanged. The yen drops. We'll hear from Governor Ueda later this hour.
A quick check on the markets here. It is the first day of May, and we're kicking off the month with a little bit of positivity on both sides of the Atlantic. Now, keep in mind, the European markets, a lot of them are closed, but the FTSE 100 very much open today. Futures indicating an open of about 0.6% outperformance over in the States. A lot of that driven by the tech story. Anna was talking about that dovish view from the BOJ, certainly reflected in dollar yen, a 144 handle there. And Brent crude on the cusp of 60, a 61 handle at the moment, trading about flat, but keep an eye on that asset. The countdown to the opening trade starts right now.
First of May, good morning. Most of Europe is closed today. The UK is, though, open. So we have a few corporates that we need to digest before we dive into what is happening with the tech story overnight and the tariff story as well. So let's deal with that first, and then we'll move on and talk about the big tech story. So a bit of breaking news coming out of Lloyd's. Statutory pre-tax profit, 152.52 billion. That's a tiny miss. However, I think there's actually some quite positive news coming through from Lloyd's this morning, particularly on the net interest income line, 3.29. That's ahead of estimates. The net interest margin, 3.03. Estimate 2.99. That's where the market is focusing. You've also got to realise this is a domestically focused institution, but that comes with issues as well. We're going to get a big ruling on car financing over the summer. We're kind of in a bit of a limbo period before we find out the details of what is going to happen there. But nevertheless, the Lloyd's numbers this morning look pretty solid.
Right, yes. And as you say, no comment so far we can see on the car financing and no extra provision there. That's as expected, but good to see if that is indeed the case. Let's go to LSEG then, Guy. We've got numbers coming out of the London Stock Exchange Group, or LSEG, and we have there some total income numbers pretty much meeting estimates. I mean, there seems little to see here, effectively. The group's still seeing full-year revenue at constant FX within the range they'd previously guided, 6.5% to 7.5%. So that seems to be as they had anticipated. If you look at where the performance in the first quarter came from, data and analytics, a little bit light of estimates, but you wonder how many estimates are in the mix there. So we'll keep an eye on some of the detail, but we'll see how that one goes down in trade later on. We've also had a trading update from Rolls-Royce, but they're sticking to guidance as well. Chrissy, we need to move to things bigger, perhaps, in terms of tech.
Absolutely. Well, Rolls-Royce, as you mentioned, sticking to guidance, but still worrying a little bit about the tariff story. And that's the message that we absolutely did not hear from the tech earnings in the U.S. session yesterday, in the U.S. after session, I should say, where a lot of companies, I think, that we've been covering on both sides of the Atlantic are bracing for some sort of impact. Some of the trends that have been driving the upside in the States, that AI investment, that CapEx investment, the ad spend even, actually moving both Meta and Microsoft to the upside. And I thought this was really interesting because when you're talking about Microsoft, it's not just the Asia business you want to keep an eye on, it's just how much they're putting into the CapEx. The minute that U.S. tech pulls back on some of that business spend, that perhaps is a red flag of the economy, but we're not really there yet. A small pullback, but not big enough to worry the markets.
Are these tech companies defensive again? Because these numbers would seem to suggest that maybe they are. They seem to be able to navigate what is happening around them reasonably well. I appreciate we're going to get Apple later on today. I think that's going to be really interesting in telling us a story about actually the effect that we are seeing, particularly on the more hardware side of the business. But they still trade on really strong multiples, high multiples. And I think this is the difficulty that a lot of people are having at the moment in terms of analysing these companies. Badly beaten up, multiple compression. But are they actually still defensive? Can they still deliver?
Yes, and I'm really interested to see the way that the market responds to the numbers these businesses put out. Because Meta, for example, I remember times where Meta would come out with a message saying, we're going to do a lot more CapEx, we're going to spend a lot more, invest a lot more, and the market would be nervous about that and say, hang on, we're not sure if we want all that. They did that yesterday. They said they're going to spend a bit more, and they even said why, some of the costs going up as a result of tariffs, and yet the market found the positives in there, and the stock goes higher. Just a caution on Meta, though, the CFO flagging reduced Asia-based e-commerce exporters spending money with the platform, and that seems to be something
that's the advertising story.
Yes, and that might take us on to the earnings story later with the likes of Amazon as well.
Absolutely. Let's talk about GDP. Big turnaround yesterday with US markets, huge turnaround. Haven't seen a big turnaround, 2% down to finishing basically flat for quite some time, I think 2022. The GDP data, I think, was part of the narrative we saw yesterday, and the market kind of spent the day, I think, digesting what we learned. Basically, I think the data it could have been worse.
Yeah.
I think is the narrative. Let's just park the Trump stuff for 1 minute. But I think the data could have been worse, and I think that probably is the takeaway from all of this. There was some tariff turbulence, but the consumer's holding up. It looks like actually fixed investment to the story around what is happening with the AI story is holding up as well. It feels like this is it could have been worse story, but we don't know yet story.
Yeah, indeed. But I do feel like the tariff story is writ large over it. I mean, just look at the surge in imports, obviously is very tariff related, but also, and that detracted from GDP. But something that boosted GDP was inventories. And I mean, that's tariff related as well, isn't it? So, you know, as you say, we'll leave the politics out of it, perhaps, because that conversation perhaps never comes to an end as to who owns exactly which bit of the calendar when it comes to GDP. But there does seem to be an impact from President Trump's policies already in these GDP numbers, and we'll wait for the next quarter.
Absolutely front-running it. And a lot of the economists, though, saying that even though we did see that slight contraction, maybe the numbers could have been worse, the next quarters are the ones that are to watch, because that's where you get more of the pain. I'm going to bring the politics back into it, though, because Donald Trump is still saying kind of what I think the markets were expecting, that get all the pain out of the way, get all the front-running out of the way, the boom begins later. Whether or not that has merit is a different story.
Okay, let me pour some cold water on that idea. You've got this 90-day delay, okay? So basically, we're going through a second phase of this now.
Yeah.
Companies are trying to front run and get as much done as they can in this 90-day pause. So you're going to get the same effect again, potentially, in the next set of data. Look at the European data. What you're seeing at the moment is something of a little bit of a surge going on at the moment. You can see that in the slightly above expectations numbers we're getting out of Europe. That would suggest that you are seeing a boom in Europe because we're trying to feed the tariff story, that we're trying to get in front of the tariff story in the United States. So I think all of this kind of fits together, but I don't think we're done with it.
Right, no, the timing of all of these tariff deadlines is really important, and you're right to point it out. I just want to throw in, as we're thinking about what is driving market sentiment, some of the lines around trade are really interesting.
Absolutely,
so China saying that the US, or a Chinese outlet at least, saying that the US has reached out on trade, but then Jamieson Greer, the US trade representative, saying there are no official talks. Now, both of those things could be true or not true, and all of this seems to have so much opacity as to where the trade conversation is going or not going between the two world's largest economies.
The USTR is also saying that he's expecting deals fairly soon, not with China. Not China, which is critical. But you've also got this EU going to share a paper with the US next week, which apparently is going to contain potentially some options or a starting position, maybe to move these trade talks forward.
Talking of trade talks, the Japanese talks with the United States continue later on today, and I mentioned that because the yen is dropping. The yen is down 0.7% against the US dollar. Now, this is BOJ related. The BOJ has held rates, but the outlook they produced, the GDP downgrade, comes across as pretty dovish and does start to raise questions about, is the BOJ really still hiking? And we'll be looking to Governor Ueda later on today to give a sense of that, and he might be motivated to give us that kind of hawkish line, if that is indeed the truth and what the Bank of Japan is leaning towards. But also, he might not want to see the yen drop, or Japan generally might not want to see the yen drop 0.7% as they go into these sort of complicated, politics-laden trade conversations later on today.
So we have a lot to discuss. I appreciate that most of Europe is on holiday today, which is very nice. The weather's going to be fantastic. I hope you're enjoying it. If you do have the day off, we do have some guests joining us around the table, though, this morning. Laura Cooper, Nuveen Global Investment Strategy, is going to be joining us very shortly. Colin Hunt, the AIB CEO, is going to be joining us as well. Sebastian Regler, Bank of America's Global Research European Equity Strategy Head, will be joining us in the next hour, as will Yusuke Miyari, Nomura's G10FX strategist, to talk about what we're getting from the BOJ.
Well, you mentioned a lot of the European markets are close today, but plenty of U.S. data to keep us interested, I should say. At 1:30 p.m. UK time, those U.S. jobless claims are going to be hitting the wire. About 90 minutes later, you get the ISM manufacturing data as well. Both may be showing a little bit of signs of potential weakness if we're looking at numbers coming out of, say, for example, the federal job losses. That's going to show up in the jobless claims. If we're looking at an impact on manufacturing, that's going to show up. But I think the highlight today is going to be a continuation of that tech story. Amazon, Apple, do they share the same positivity that perhaps Meta and Microsoft
Right, they're very different tech businesses, and of course there are software elements to both of them, but there's also a real hardware or real world goods element to both of these businesses. And so tariffs seems to be the theme. Where is Apple going to be producing these phones that go into the United States? There's a lot of talk about India, of course. And in terms of Amazon, you know, they rely so much on these on supply out of China, and they're now subject to 145% tariffs on that. And China exporters also pay advertising and logistics to Amazon. So we'll see whether there's impact there.
Absolutely, but just don't obviously tell everybody what the tariff prices are going to be in terms of the final.
No, that would be too much visibility.
That would be far too much visibility. I think the ISM is going to be interesting. I think the prices paid is going to be interesting. That's expected to tick up quite sharply. So you're going to see an inflation story here. Broadly, manufacturing is flat on its back at the moment in the United States, but the survey's for 47.9, and this is a number that's going to tick lower. US manufacturing is struggling, and you're seeing that in the corporate reports. Yes, I appreciate the numbers coming out of the tech sector are strong, but nevertheless, elsewhere, there is significant weakness. Take a look at the US manufacturing sector if you want to see it. What else do you need to know this, Thursday morning? Spain's antitrust agency has approved BBVA's $14.8 billion bid to buy Banco Sabadell. It has, however, added some conditions. These include commitments from BBVA to keep certain branches open and maintain commercial terms and credit volumes for small and medium-sized companies. The government now has 15 days to review the regulator's decision, and if it proceeds, 30 days to make a final ruling. If the deal does go through, it would mark the largest European banking deal in almost 20 years. Internal, though, not external. This is not a cross-border deal. Airbus says it won't cover the cost of tariffs on planes imported by US airlines, potentially setting up a clash with the carriers. The plane maker's CEO says the customers are not willing to pay it is not willing to pay the levy. And says, quotes, this is Guillaume Fauré, says it's on them. The company has reiterated that it still aims to deliver 820 commercial aircraft this year, but the target does not include the fallout from tariffs and assumes no, quote, additional disruptions to global trade or the world economy. So basically, we've got guidance, but we know there's a fairly big factor that is going to work against that guidance. Anyway, the US and Ukraine have signed a deal over access to the nation's natural resources. The agreement grants the US privileged access to the new investment projects to develop Ukraine's natural resources, including aluminium, graphites, oil and natural gas. Kyiv hopes the agreement will secure President Trump's support in ceasefire talks with Russia. Is this... I'm wondering how big a step forward this is. We've been waiting for this deal to come through. Everybody's got very excited about it. How does this change the negotiations with Russia is the bit that I don't understand. This was a big sticking point a few weeks back, but the sticking point seemed to have changed and now seem to be about territory. So does this in any way resolve that? Does it mean that the US is more on board with Ukraine? I don't know. Yeah, it seems difficult to fit this alongside what for many people would be the more substantive conversation about peace in the short term, peace in the longer term. I mean, the US answer on security and whether this provides any security, President Trump goes back to saying the same things about you'll have US people on the ground and interests in your country, and that will put bad actors off. But, you know, I'm not sure that's acted as a barrier to bad actors and invasion in the past in other geographies. So we'll see how that plays out. It's fascinating that we're talking about access to these critical minerals at the same time that we're talking about an investment fund being built in Ukraine as well. It's still not clear what that investment fund actually looks like. Is that one that's tied to reconstruction of the area? That's been something that's been floated in the past. That is something that seems to be talked about. But it's also interesting that it gives the US a stake in the profits that are to come and some way of reimbursing them for money they send from now to Ukraine. So this isn't about reimbursing them for money spent up to this point. It's about further money. If you assume this as a positive, assuming that Europe would be open today, would European equities rally on the back of this? Is this something that you can look to and say there is a dividend coming, that peace is coming, it is more likely to come now in Ukraine, and as a result of which we can price that in and give European equities, European assets a boost off the back of it? Perhaps a little. There was a line in the story saying any engagement by the United States is a positive. So maybe that would be something that people would cling to. But good question. We'll wait for tomorrow and see how they do respond. Coming up on the programme, let's tell you what's coming up. BOJ Governor Kazuo Ueda will kick off his press conference in a few minutes' time, in fact, just over 10 minutes' time. We will bring you the latest. Will there be any hawkish lines in contrast to the fairly dovish statement coming through from the BOJ today? Plus, Apple and Amazon report today after a strong showing from Meta and Microsoft. We'll preview the results there. Up next, US GDP contracts, but Donald Trump asks for a pass while he turns things around. And markets don't seem too concerned. They were for a while yesterday, but then turned that sentiment around as we moved on to start thinking about tech earnings. We'll discuss all that next. If you have any questions, if you want to get involved in any of these conversations, IB plus BBTV Go. That is the function to use. This is Bloomberg.
core GDP, and this is, you probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump, because we came in on January, this is the quarterly numbers. Let's give us a pass on the first month. We were sort of getting a little bit used to things.
There's probably some truth in that. Let's not deny it, that probably this is a reflection of the administration prior coming into this administration. I don't know. Take the politics out of this and look at the data. I think is probably the way to go on this and what it tells us about where we are with the economy. That's what Val's here for. And she's got some great charts.
Guy, good morning. Yes, I've got a chart behind me, which I know has a lot on it, but it's essentially the quarterly GDP broken down by component. You can see here, this line in green, this was the drag of imports on yesterday's GDP print. Nearly a 5 percentage point downward drag on GDP from those imports. And Anna, as you noted, there also was a big jump in private inventories that also really muddled this data picture. But Guy, some out there arguing that the big takeaway is that personal consumption and fixed investment still held up pretty well. We're still looking at a pretty solid U.S. economy when you strip out these dimensions that were maybe warped by those front-running the tariffs coming in. And look at the equity market, Guy. Yes, we were negative when this data release came, but those month-end rebalancing flows really pushing the S&P 500 a lot higher into the close. We rallied more than 1% in the last 30 minutes of trade. That winning streak continues for a seventh day, and those positive tech earnings has the S&P futures up nearly 9% in the last 8 days. Guy, the excitement doesn't end there. Take a look at the rally that's happened in the Treasury market. These 10-year yields down some 23 basis points in the last 8 sessions. There seems to be a lot of calm in the market. If you look at April, look at the scorecard. It almost does not reflect the amount of volatility that we had this month. The S&P 500 only ended marginally lower, down 0.8%, and those 10-year yields only 4 basis points lower.
Yeah, nothing happened, nothing to see here. We can all move on. Life's good. We can go back to where we were before. Valerie Titel, thank you very much indeed. Joining us now, Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Good morning.
Good morning.
Can we go back to where we were before? Is it all good? The market's kind of all fixed? Nothing to see here?
I think so. That's certainly what the price action is telling us. And I think the rebound that we have seen has been surprising, but also unconvincing. And I think taking a step back, it's really a two-story situation between rates and risk. So risk assets are really pricing in, to your point, the fact that maybe there is nothing to see here. The tariff backdrop is going to be relatively benign, and so we can focus on the tax policies coming through. But then to Valerie's point about the rates backdrop, we're clearly seeing markets price in more of that recessionary risk, the economic damage. And I think that's really probably the story that has yet to fully play out. And risk assets, I think, are going to have to catch up to that narrative.
Okay, catch up. It's got to play out. What does that look like?
Well, I think we're already seeing that come through in terms of earnings expectations, right? Just the extent that we're seeing in terms of consumer sectors starting to come under pressure in the U.S. We're looking at sales misses surging quite materially. We're looking at kind of guidance coming in quite negative, really a deterioration that we haven't seen since the pandemic. And I think there's this degree of uncertainty, certainly in the data that has yet to come through, in the hard data, in the labor market, for example. As we start to see some of that materialize, we're going to see that probably risk assets come under pressure on the back of that. And then, again, this tariff deadline, the 90-day reprieve that you were mentioning earlier, that, again, does inject greater uncertainty into this overall backdrop, which does set us up for greater kind of choppy price action.
Choppy price action, and for some people that's a problem. For others, that perhaps leads to opportunity, Laura. What we have seen during April, I was looking at S&P stock correlation, so the extent to which stocks moved together with each other, it was the highest since 2020. So there were big things dictating risk appetite and sentiment during the month of April, which seems to make sense. And that often means there's fewer places to hide as well. Are we going to start to be able to discern as we go forward places to hide from places that are much more vulnerable?
I think that is the case. Certainly, one of the key themes that we've heard from earnings season so far is one of dispersion, both in the U.S. and in Europe. And that does suggest we are going to see greater opportunities to take on sector exposure where we think they're kind of more immune, let's say, to the tariff backdrop. So I think in the U.S., financials have surprised, industrials have surprised, whereas kind of what I pointed out earlier, the consumer sector is really where we expect to see greater challenges going forward. And then in Europe, I think it's not only a case of dispersion at the sector level, but even digging a layer deeper. Autos, for example, we are seeing those corporates that have less exposure to the U.S. actually proving to be quite resilient. We are seeing, robust European domestic demand. But again, kind of that dispersion within the sector does suggest you really need to have that active management approach amid this volatility.
OK, so there's room for the active manager there then. What about how we should read trade deals? I mean, Guy was making that point earlier about how we're sort of desperate for a period of time where we just get a clear read on what the market thinks, how businesses are coping with trade tariffs. But this is a moving feast. It moves all the time. And things could move quite considerably over the next month or so. We might get a trade deal with India. We might get one with Japan. Who knows? We might get with all kinds of geographies. If we get those kinds of deals, but we don't get China, we don't get Europe in a hurry, where does that leave risk sentiment, do you think?
I think it leaves risk sentiment in still a precarious place. And that's because ultimately, if we look at the trade rollbacks that we're seeing in terms of the headlines, all that does to serve to do is to inject greater policy uncertainty. And that is going to keep businesses in a wait and see mode, not only when it comes to investment plans, but also hiring. So that does portend kind of greater cracks in the labor market, which is yet to materialize. And then on the consumer side, it's likely going to see kind of a greater pullback in discretionary spending. That is going to have ripple effects. And that's before we overlay the potential inflationary impulse of all of these tariffs. Because even if we do see these negotiations come through, this is still going to be a high tariff regime relative to what we've seen in the recent past. But perhaps from an investment perspective, it's about taking on those exposures where we do see greater scope for a deal. Yeah. So Japanese equities, for example, is perhaps one area to seek.
Well, you talk a little bit about this kind of investment impulse from international investors here. And from an asset class perspective, it's clear that they're fleeing the United States, or at least deleveraging a little bit that exposure. But from a corporate perspective, no one's pulling out of the United States just yet. In fact, you've seen some announcements of them kind of doubling down. Where does that factor into kind of maybe offsetting the impact of tariffs?
And that's a great question. And it's actually probably the question that comes up most when I speak with investors. And that's around, is this rotation away from U.S. assets that we're seeing on the investor side, is that kind of a temporary blip, or is this reflective of a structural shift? And to your point around corporates really not yet kind of buying into that kind of paradigm shift narrative, perhaps that does suggest that this is just a temporary reallocation, which does make sense in an environment where the U.S. economy is going to come under greater challenge on the back of this policy uncertainty. And from a relative valuation perspective, Europe is better positioned on a tactical basis. We have that fiscal stimulus kind of impulse coming through. And I think overall, looking at kind of that 12 to 18-month horizon, which investors look to, I think that does suggest that we are going to see that further rotation from the U.S., even if not on that kind of structural basis at this juncture.
Assuming that fiscal impulse does actually fully make it to the economy. Laura Cooper, global investment strategist and head of macro credit over at Nuveen, walking us through some of the factors and some of the geopolitical volatility weighing in on some of these markets. Coming up on the program, Colin Hunt, CEO of AIB Group, joining us as we discuss the bank's trading update and outlook. We'll also get the latest from the BOJ. Governor Ueda speaking shortly. That conversation next. This is Bloomberg.
Welcome back to the programme. It is Thursday, the 1st of May, which means that a lot of the markets in Europe are closed. The London market will be open, and the futures picture for London looks positive, up by 0.5%. US futures look more positive, and this is a tech story, though. This is to do with the numbers we had out of Meta and Microsoft. That seems to be the thing that is pushing sentiment up a little bit, and we saw a big reversal during the session in the US yesterday around that GDP number. So we'll keep all of that in mind as we look at what is happening stateside. So, Critty, expecting to see equity markets move a little higher later on today.
A little bit of positivity, but of course amid quite a bit of less volatility or less liquidity, I should say. At the same time, we are monitoring the comments coming out of Japan. The BOJ announcing this morning that they are staying put, but really contracting when it comes to their growth outlook, delaying a timing when it comes to some of their inflation targets as well, really bracing for what perhaps the policy out of the United States may come for. A dovish take was the read here. We'll see if Governor Ueda, who has just started speaking in Tokyo, has anything to say about movement. 144 229 basically on dollar yen, so a little bit weaker this morning. On
the yen down by 0.9%. We'll see if Governor Ueda says anything that moves that around. Let us move on to the European corporate landscape and the banking sector. We've had many conversations about the banking sector with European banks this week, going through what has been up to this point a fairly resilient picture being painted by some European banking names. We have a trading update from AIB, and they have an investor day or a meeting with shareholders, later on today. So AIB Group confirming lots of the guidance that we previously had around full-year net interest income, for example. Let us get into a conversation about the banking and global economic landscape with Colin Hunt, CEO of AIB Group, who joins us now. Colin, nice to have you with us. Thanks for being with us. So some of the headlines this morning seem to be around sort of sticking to the guidance in a lot of the areas. We've been painting a picture this week of a banking sector across Europe that is pretty resilient to all of the volatility and perhaps in some cases benefiting from it, where large investment banks are present. Do you see any evidence, though, amongst your customer base, even if your business is insulated a little bit, do you see any evidence of sort of tariff volatility amongst your customer base? Any red flags?
Well, we're off to a very, very strong start in the first quarter of the year. We're reiterating all features of our guidance. And at the moment, the business is actually performing ahead of plan. We had total new lending growth in the first quarter of about 14% on a year-on-year basis, with 34% mortgage market share. Very pleased with that. Over 60% of our new lending in the mortgage area being green in nature. As of now, we are not seeing any signs of unease or reduced confidence in terms of our customer activity. And we're very, very happy that we are going to be reiterating the guidance we gave when we produced our full year numbers back in March in relation to our ROTE. We regard that as our North Star target. We said in March that we were going to be meaningfully ahead of that medium-term target in 2025. We remain comfortable with that, and we expect to comfortably meet that target in 2026.
Colin, just taking a step back and looking at the bigger picture, though, the Irish economy has benefited from low taxes and high investment over the last few years. Donald Trump has called out the Irish economy, and he has said he wants some of that business back. Should we expect a slower Irish economy going forward from here?
Well, I think it's an inevitable, Guy, that given the increase in trade tensions internationally, and we've seen that over the course of the past number of months and number of quarters, that we are going to see more moderate growth internationally and probably higher price pressure internationally as well. And that's factored into our expectations of where we see modified domestic demand going. Now, the great irony is that we've seen a surge in exports, particularly from our pharmaceutical sector, in the first months of the year. Very, very substantial growth being reported by the pharmaceutical sector. So the GDP number for 2025 is actually going to be quite stellar. We tend to focus on modified domestic demand. That's far, far more relevant from the perspective of our business. It's currently running at about 3%. And we would expect it to be in a 2.5% to 3% range for the full year. So it's more modest than the level that we might have been used to in recent years, but it's still a very, very strong performance, particularly by reference to the other countries in the Eurozone and indeed further afield.
Colin, it's Creedy in London. Building on the point the guy was making around the geopolitical volatility and the impact on the Irish economy, you seem pretty upbeat in response to that kind of global risk. What does that do in terms of turning AIB fully private and returning it to that fully private ownership?
Well, we've seen a very, very significant reduction in the state's shareholding in AIB Group. We had our IPO back in June of 2017, and at that point, the state owned more than 71% of the group. The last time that we had a market announcement in relation to the state's shareholding, it was put at just shy of 12%. We're having our AGM today, as Anna said earlier. We have an approval from the European Central Bank for a directed bilateral buyback with the government of 1.2 billion. We're bringing a motion to the AGM this morning and seeking our shareholders' approval for that directed buyback. And then, of course, the board will have a decision subject to that approval. The board will have a decision to make as to whether that approval or that transaction is in the best interests of the company. If it proceeds, it would have the impact of reducing the state's shareholding to something of the order of 3%.
The issue is the share price, which is down a little bit. We're trading at 5.9 this morning. I think the offer price is 6.37. Given that share price move, do you think this represents a good deal? Is this the right time to be buying that business back, buying that stock back from the government?
Well, I'm not going to preempt the decision of our shareholders at AGM today. The strike price is set at 6.26. In the event that we get that approval today, that has a validity which extends all the way to the end of trading on the 8th of May. We are dealing with, obviously, a volatile market backdrop, and let's wait and see what ensues. But first of all, the number one order of business is getting that approval from our AGM today.
Colin, we've talked in the past about the salary cap that exists in Ireland, and if that shareholding does come down to 3%, does the sector, do you as a business, have a stronger hand, I suppose, in trying to persuade the government to change its policy there?
Well, that's ultimately a decision for the Irish government. And as I've said on a number of occasions, I focus all of my energies, or try to at least focus all of my energies, on where I can bring influence to bear, and that's in relation to the day-to-day running of the business. The remuneration restrictions that are in place, their removal, ultimately a decision for the Minister for Finance.
OK, Colin, thank you very much. Thanks for joining us. Good to have you on the programme. Colin Hunt, the CEO of AIB Group. As Colin has been speaking to us from Dublin, we have also been hearing from Governor Ueda over in Tokyo, talking about monetary policy, of course, Kriti, and what they're watching for in terms of that path to further rate hikes, which has been, up until now, the market's base assumption.
Yeah, absolutely. And something that's been boosting the Japanese yen in the face of all the volatility. This morning, you are seeing the exact opposite trade. You're seeing dollar yen at 144. Some of the early comments coming from Governor Ueda is just uncertainties are higher than usual, kind of in line with what we've been seeing from the commentary of central banks and leaders around the world as well. He's talking about the trend to be in line with their gold in the second half of the period. That seems to be a little bit more of a delay than they had talked about in the previous iterations. They're also talking about they're going to keep raising rates if the economic outlook is realised, but really laying out the risks around that.
Right, so there was this emphasis on the risks, just quite dovish. GDP estimate come down. That was all in the BOJ statement earlier, and he seems, as you say, to be reiterating that sort of dovish line. But then there's that line, as you point out, keep raising rates if the economic outlook is realised. I wondered if that might constitute a little bit of hawkishness at the margin, and that might bring dollar yen into line, but it has not moved it one bit.
No, we are at session highs for dollar yen, just off session highs for dollar yen right now. In fact, we've seen over the last few minutes dollar yen taking another leg higher. So the market continued. There was a little bit of a fade into the beginning. Now we see a little bit of a pickup back again. The market saw the initial statement as being dovish this morning. There is nothing, it seems, judging by what is being said thus far, that is going to dissuade it from that.
Yes, and if that earlier hawkishness in previous meetings was about price pressures, Governor Ueda now saying they expect the price trend improvement to stall temporarily. So that also seems to remove the urgency when it comes to any need to hike rates.
Let's talk about tech. Well, let's talk about tech next. Coming up, Microsoft and Meta getting big tech earnings off to a good start. Shares higher in after-hours trading after the numbers beat estimates. Outlook looked pretty good. We're going to have the details next. This is Bloomberg.
We've had a strong start to the year. Our community keeps growing with more than 3.4 billion people now using at least one of our apps each day. Our business is also performing very well, and I think we're well positioned to navigate the macroeconomic uncertainty.
Meta CEO, of course, Mark Zuckerberg, speaking on the earnings call with analysts. Now, both Meta and Microsoft shares surged in late trading after the tech giants reported better than expected earnings. It gave a sort of resilient presentation of the outlook as well. Bloomberg's Charlie Wells has all the details for us. Charlie, what's propelling these firms then? What is it that comforted the market?
Anna, the issue for investors with these tech firms is, sure, they can release flashy AI tools, but how do they actually start making money off of them? And both Meta and Microsoft were able to tell a story of these commercial use cases, and the market yesterday liked what it saw. Let's start with Meta. This is a company that is so reliant on advertising. 98% of their revenue comes from advertising, and what they have been able to show is something of a virtuous cycle, where this new technology helps them personalize, helps them target ads, and that helped them beat on ad revenue, creating that virtuous commercial cycle that investors have been wondering about. Microsoft, different company, but still very able to tell that AI story. So when you think about their Azure cloud unit, they were able to show a 33% growth in the quarter. That's great, but when you dig into that a little bit more, you get an even better tale. The company said that 16 percentage points of that growth came from AI. So that is compelling. You've also got CapEx in the quarter trending down. This has been another issue for investors, seeing so much expenditure on AI-related CapEx, seeing some of that rein in, that indicates prudence. So this is, again, both of these firms able to show this commercial use case for AI. Later today, we're going to get Apple and Amazon. They've got different businesses still in that Mag 7, but they've got hardware and retail to think about. Could be a very different story.
Yeah, watch for those numbers a little bit later on. Charlie, thank you very much indeed. Charlie Wells walking us through the latest on what is happening with the tech narrative. Cree's got our eye on a different space this morning, the pharmaceutical space.
A different space, but perhaps the same theme in terms of an exposure to China. And I think that's really crucial. It's the one piece that Charlie didn't mention there, because a lot of those tech companies, of course, from a stock perspective, are very volatile when it comes to that headline. Microsoft is a great example, but the pharmaceutical space, guys, you mentioned, is another key exposure. This is a chart I grabbed from our very own, from Apollo's Torsten Slock, and I think this is really crucial when it comes to how we evaluate the pharmaceutical sector, specifically given it's such a big industry right here in Europe, and we are on tenterhooks for what those sectoral tariffs might actually look like down the pipe. But when you look at the drug imports trade from the United States' perspective, basically how many inputs into pharmaceuticals from China come into the United States, the numbers are staggering. So I'm going to start from way over here, where about 95% of those drug imports come from China when it comes to ibuprofen. You look at some of the others, hydrocortisone, for example. These are one of the two most easiest accessible drugs at a pharmacy in the United States. 91% of those inputs come from the likes of China. So, Anna, when we're talking about these kind of trade talks that the CCTV, by the way, Chinese media, has suggested are initiated from the Trump administration, Donald Trump's administration, saying there's no sign of that. That hasn't happened yet. This is going to be a key sector that we look at, in addition to tech, in addition to textiles and other exports we've got our eye on.
OK, that's important, isn't it? Because if we're thinking about the reaction function of the US administration, is it around empty shelves in retailers? Is it around difficulty accessing drugs in the United States? That certainly would focus minds, wouldn't it? Let's have a look at, as we're going through all of these important news agenda items, we're also tracking what's going on with the BOJ press conference as well. And just returning to that, because we have not seen a change in direction on on dollar yen. And in fact, the yen keeps weakening and is now almost 1% weaker against the US dollar, continuing to weaken. Some of the most recent lines suggesting that perhaps the hawkishness that had gone along with the previous outlook from the BOJ is just a little bit less intact. They're saying that the outlook could change if there are big shifts in tariffs. The likelihood of the outlook isn't as high as it was before. And if it's that outlook that was underpinning the hawkishness at the BOJ, then maybe that means you're less likely to get there.
Any more hikes in 2025? Looking increasingly unlikely, isn't it, that we are going to see any more hikes coming through from the BOJ? Are we going to see, therefore, a significantly weaker yen? That has been a factor that obviously we've needed to fold into the broader trade story. If that continues, that's going to be interesting as well. The dollar's been weak. The yen is a big component, a not insignificant component of, obviously, the baskets we watch when it comes to the dollar. And if we are going to see a weaker yen, stronger dollar, that is something that speaks against some of the recent trends that we've been seeing around the world, where you've seen a weaker dollar. Does that start to maybe mitigate some of that dollar weakness that we've been seeing elsewhere? And does that, as it's such a big overlay at the moment in terms of people's perceptions of other assets, start to change people's thinking around that as well? Maybe put a more positive spin on investing into the United States.
Is the dollar a risk asset now? I mean, is that how we... Well, it is, but is it going back to not being? And I say this in the context of the fact that we're looking at a dovish yen this morning, but then you look at some of the other kind of traditional, it's a risk-on day, and you see the dollar up, to your point, the risk-on. You see the euro down, you see the pound down, but you also see the likes of the Mexican peso, the Brazilian real up as well. So we're talking about the carry trade here. The fact that the dollar and the yen kind of falls under that basket, to me, I think is quite interesting.
And we'll continue to watch what happens with this currency as we approach this next round of trade talks between Japan and the United States. The yen now down by 1% against the US dollar in this session, as we've had this pretty dovish outlook from Governor Ueda and the BOJ. And does that make things a little more difficult as we go into that conversation? Because even if we've heard lines suggesting that the FX conversation was not previously part of the core tariff conversation between the US and Japan, it is something that we know the President of the United States is very animated about.
Absolutely. But it also has an effect on the Treasury market. Japanese investors are big investors into the Treasury market. Does a weaker yen change the narrative around that? How should we think about, therefore, what is going to happen in US Treasuries as a result of this? In terms of the dollar story, this is, for many investors, this is the pivotal piece of the puzzle right now. US markets, if you're a US investor, equity markets have done actually very little, you could argue. If you take a look at the numbers today, and we've round-tripped, obviously, through the last month. But if you're a foreign investor, if you're a European investor, if you're a UK investor, it is the dollar that has been the critical factor in all of this, and your numbers look much, much worse.
And thinking about Japanese appetite, I know we've got a guest coming up in about, 40 minutes' time, who has the view that, yes, there's a lot of talk about de-dollarization of the global economy, but actually Japanese investors, in his view, he says he hasn't seen much evidence of Japanese investors coming out of foreign assets. So that's an interesting one to watch. And as we've noted, red headline across the Bloomberg, the yen extends losses to 1% against the dollar, as we mentioned a moment ago. Joining us now to talk about this and other market dynamics in 3 minutes, let's talk to Ven Ram, Bloomberg Markets Live currency and rates strategist. Ven, weigh in on the yen and the broader role, I suppose, of the yen as we're watching all of the drama around tariff conversations. That, as Guy's saying, was weighing on the dollar. But now we're in a situation where the yen is weaker. Take this into the global context for us.
Well, Anna, in one fell swoop, the Bank of Japan has disbanded the jury of yen bulls. I mean, they not only have they revised lower the outlook for growth, they've also said that it's going to take longer for them to achieve the inflation target. They've pushed it back into fiscal 2027. What does that mean? In concrete terms, it means that real interest rates in Japan are going to stay frozen. They're deeply negative, and therefore there is no incentive for investors to bid up the yen. So what it means is that the dollar-yen part of the trajectory is going to be dictated by the dollar side of the equation rather than anything coming from the yen side of the equation. And therefore, I think that the yen is going to be vulnerable in the coming weeks, but even so, I think that any declines are going to be measured. We are not going to see the yen go back to 153 levels anytime soon, just because the BOJ is not going to raise rates. But the fact is, real rates have improved, even though they are still negative. They have improved in favor of the yen, and therefore that's going to put some kind of a floor on the yen. But as we discussed yesterday, the dollar is kind of oversold at these levels. And I think that, if a mean reversion theme would get the dollar back up. So I think that, in net, we are looking at some kind of weakness in the yen, but not a whole lot.
If the dollar is strengthening against the yen, does it strengthen against the basket? Does it strengthen against the euro or the pound, for instance, then?
Yes, I think it's going to strengthen against the euro and the pound as well. The pound in particular is kind of overbought. The pound's levels at around 134 is completely incongruent with what's going on with the UK economy, Guy. I mean, we know that productivity is in a funk. The economy is sputtering. Real estate prices are tanking. And inflation is still elevated relative to the BOE's target. And that inflation has been chipping away at the purchasing power of the pound. So at 134 levels against the dollar, the pound is hugely overvalued and mispriced. And I think that misprice is waiting for a correction. And that correction will come when the dollar bounces back to its reversion. And I expect that to happen sooner rather than later.
Ben, when we're talking about kind of the haven bids across varying currencies, whether that's Europe, whether it's the dollar, whether it's the yen, where does the Swiss franc fall into all of that?
Well, I think the Swiss franc is going to be very well bid, and I think that it's been a stunning outperformer, notwithstanding the fact that the S&P is not going to like that strength. But the fact is, while the Swiss franc has appreciated a whole lot against the US dollar, its appreciation against the euro has been more nominal, more or less subdued, and therefore I think that the franc is going to continue appreciating, and that's going to pose a headache for the S&P in the coming days. And I think that they may not hesitate to take rates into negative territory. Already in June, they are going to probably go into zero bound, and I think further down, we'll have to see what inflation happens.
Certainly something we're going to keep our eye on. Bloomberg Markets Live currency and rate strategist Ben Rom joining us this morning. He makes a crucial point there, which is that we're not in the clear just yet, and therefore all these currency kind of trades that we've seen, whether it's a haven bid, whether it's based on kind of terms of trade and the tariff story, all of that is still, frankly, a hot mess.
Yeah, we don't know anything.
Yeah.
We've got all kinds of different deadlines that we need to be working with. I will point out, though, that despite Ven's sort of negativity at least it's sunny outside.
It is sunny, and we'll take what we can get, won't we?
Yeah, definitely.
US futures are higher as well. I'll point that out. And that is, as we've been saying, partly the tech story. NASDAQ futures are higher, but also, as you mentioned, Guy, earlier on, some of those lines around China. There's some conflicting lines around China, but at least somebody is saying that reaching out is happening around a trade deal. We'll see if that comes to pass. We'll have the open for you next. This is Bloomberg.
Thursday morning, good morning. There's a couple of things to point out, one of which is the 1st of May, so most of Europe is closed today. We are not going to see trade in the CAC, the DAX, etc., etc. The other thing to point out is it's the 1st of May, and in theory, everybody should be selling. Selling May, go away. That's not happening either. Let me show you some of the futures picture that we currently have to work with. This is NASDAQ futures. Remember, we've had Meta and Microsoft to fold in, and you can see the rally that we've seen on the right-hand side of this chart. Quite a lot of green on this screen right now. We are going to push higher, it seems, in US markets a little bit later on. London is open. We get a bank holiday Monday, so we are open today, this Thursday. FTSE futures currently up around 0.6%. You've got a number of companies out with numbers this morning. Persimmon, Lloyds. You've had LSEG out. You've got an update from Rolls-Royce. Broadly, the sentiment seems to be positive, and it looks like the FTSE 100 is going to be opening up 0.6%. I suspect you're going to see a fairly light volume session today, though, Anna.
Yeah, absolutely. I mean, it's interesting that the FTSE futures are up as much as they are. The numbers seem to have come in broadly in line with expectations in terms of the corporates that have reported today. We're not chock full of tech names to echo the Meta and Microsoft move higher. So is it those lines around China, about the US possibly reaching out on some kind of tariff conversation that's going to lift sentiments on the London market today? Let's see. But in terms of stock specifics, Lloyds Banking Group, I mean, we don't get a clean reading on anything, it seems, these days. Home buyers were rushing to beat the stamp duty rise in the UK, and that's something that boosted their business. Over at LSE Group, LSEG, those numbers coming in broadly in line with expectations. And Whitbread in the consumer-facing businesses, their profit numbers missing estimates, but there is talk of a buyback, so that's also something we fold into the mix, Guy.
OK, here we go. It's a very exciting open. It's Thursday morning. We have the FTSE 100. OK, let's talk about the numbers that we are going to see. Here we go. It is time for the opening trade. It is a very limited opening trade. We're going to watch this. We are on tenterhooks. We are anticipating a rise of around 0.6%. It is not materialising yet. I'm not sure I've got much more to say on this subject. In fact, we turn negative. The market, I think, is struggling to find a sense of direction. The estimate is, though, that we are going to see things pushing a little bit higher. Maybe up by 0.6%. Europe is basically closed today. I don't think we're really getting very much sense of direction out of the FTSE 100.
Not as much optimism as perhaps the futures were suggesting. And are the futures really reacting to positivity in the UK, which I feel like is a rarity, or are they following?
It's sunny. Look, just go with the weather. I think that's
it's sunny
all
outside,
the positivity.
So it's sunny in the markets.
Yeah,
Fair
people are going to go shopping. Maybe that's a boost for the economy. I can at least point that out.
Is Guy Johnson being bearish or being bullish? That's
about the weather.
It's unrecognizable. I don't even know what to do with it. Let's talk about what's actually moving the FTSE 100 when it comes to the major players. From index contribution perspective, I'm seeing banks from the get-go here. HSBC seems to be one of your biggest contributors this morning. Alongside Rolls-Royce, we did have that number, or I should say the trading update come out earlier as well, with a hodgepodge of metals doing well. And that That's my market analysis.
That's
this
a
morning.
technical term.
Yeah.
Rolls-Royce is doing pretty well, isn't it? 2.6% higher, which on a day where the FTSE is pretty flat isn't bad. And they do seem to be saying that the tariffs are manageable. And if companies come forward with that kind of line, that might be the kind of thing that that soothes some nerves, at least in the short term, when it comes to businesses such as Rolls-Royce.
Absolutely. Let's talk a little bit about what is happening in the equity markets, though, around the world, particularly the transatlantic trade. So one of the things that we've been watching very carefully has been the overlay that you see with the foreign exchange story. So let me just give you some numbers. If you are a US investor, so far this year in the DAX, which is closed today, you've made 23%. You've made 25% in the IBEX. Domestic investors have made kind of, let's call them mid-teens in terms of the numbers that we are seeing. The foreign exchange story is having a huge effect on portfolio managers' performance so far this year. That was a subject that we addressed yesterday with Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. This was his take.
I don't think you can overstate the importance of this dollar shift. And you're beginning to see more of a sense that something structural is beginning to change here. For a long time, US investors had no real incentive to put money outside of the US, because if they did so, they'd lose money on the currency. But there was also not much growth to follow. Most of the growth was being generated in the US in mega-cap tech. That's shifting.
Peter Oppenheimer speaking yesterday. If you're a US investor, you've made 25% year-to-date in the IBEX. That's a sensational number. These are the kinds of numbers that have portfolio managers salivating. Can it continue? We've just been hearing Venn talking about the fact that maybe this dollar trade has gone too far and starts to reverse. That will have a big effect in some of these performances.
It absolutely does. You mentioned earlier as well that it's a sunny day in the markets as well. It's a sunny day in London. So what do? We bring in our Uber bear, Sebastian Radler, head of European equity strategy over at Bank of America Global Research, joins us around the table. We planned this. We completely planned this. It's all by design. But talk to us about the currency component here.
Yeah.
How do you factor that into your thinking?
Well, it's clearly you said European equities have performed very, very strongly, but now they get a currency headwind that is worth, given the appreciation of the euro that we've seen so far, around 6% off the index. It's around 5 to 6% off earnings, and in fact, over the last 3 weeks.
So you see it's a headwind?
It's a headwind. Yeah, of course. Yeah. If you have a depreciation of the currency, your foreign earnings become more valuable. Now you see earnings downgrades in Europe. You've seen 3 straight weeks of earnings downgrades because you're operating with a less competitive currency.
But sorry to jump in, but if you're a US investor, you're making big gains here. I guess this is going to suck extra capital though in. I appreciate that companies aren't going to be performing as well. Yeah. But from an investment case sitting in the United States, Europe looks more attractive. So do we start to see some of the reversal of the recent run of money into the States, out of the United States and into Europe?
No, but of course, we've seen that already. So you've seen the appreciation of the euro. You've seen strong outperformance. Europe has already outperformed by 15%. So if you want to have further outperformance for Europe, you either have to see basically a strong acceleration in domestic growth momentum, or you have to see your earnings going up. But the stronger your currency becomes, the less competitive your businesses are, and that's effectively how the market is rebalancing. So from a US perspective, the fact that the euro has appreciated has generated strong returns for your European holdings in US dollar terms. But if now the earnings are being downgraded and you potentially no longer get that kind of currency effect, that is a backward-looking story. So the question is, what happens next? What happens to growth momentum? What happens to your earnings? And the big story, of course, of growth momentum is we haven't seen the fallout yet from all the tariffs that we've imposed. We're sitting here holding our breath and see what is that going to do to the global economy. Global growth likely is going to slow, and European companies are now laboring under a more expensive currency. Doesn't sound very attractive to me.
Except that has been the narrative for, to your point, that's driven the fund flows across the Atlantic for the past 3 months. So my question to you now is, what economy in the world is most well-positioned to absorb that volatility? Isn't that ultimately the bull case that investors are making for the United States?
So I think the question is I completely agree with you, who weathers the shock best? And I agree, it's likely going to be Europe, because the US is having a trade war against the rest of the world, so they're up against an economic entity that's 4 times their size. China, the second biggest bloc, they get most of the tariff hit. They're effectively being embargoed by the US. Europe is relatively more insulated because they get less tariffs, and they effectively only have a trade war with the US. So on a relative basis, you're looking better, but you have already outperformed by 15%. So from our perspective, most of the relative improvement in growth momentum is already in the price.
So where in Europe then, Sebastian, if that's the backdrop, and you continue to sound quite negative on Europe from here then, where is going to be worst hit and where is going to insulate you?
Absolutely. And I want to be very clear, because there are two conversations that are easily mixed. The question is, on the one hand, is the relative performance, and on the other hand, is the absolute performance. So we are negative on all equities because we think there's now a growth hit coming. And I was just in the US for a week, and we had like 30 meetings, and everybody was holding their breath because you've seen the scary headlines, but you haven't seen the scary macro data yet. And so everybody's now saying, what's the magnitude of that impact? We think ultimately will result in the global PMI declining by 4 points. And what is so exciting about this, we've been sitting here with you waiting for some weakening in the global cycle for 3 years. And there were all these kind of scares, tightening in 2022, SVB collapsing in 23, the wobbles in the labor market in 24. It has come to nothing. The global economy has held up. So this likely is going to be the first real slowdown in 3 years and is not yet discounted in the market. So in absolute terms, we're negative. In relative terms, we're neutral on Europe versus the rest of the world and versus the US. And then what is attractive are the defensives that haven't yet performed. So that the staples, pharma is super interesting. It's a defensive that has underperformed in a risk-off environment. There are special factors which we can discuss. These are defensives that are further to run, and we're very negative on the financials. If you get more growth downside, wider risk premia, lower bond yields, financials look very vulnerable at an 8-year high relative to the market.
You see, that's interesting because we are sitting here towards the end of a week where we've had quite positive reporting out of financials, and lots of them have been flattered by volatility that's driven trading revenues in the first quarter, but they've seemed quite insulated from the global growth narrative. But you think that can't continue?
And I think that's the narrative for now, that people are saying, look, the earnings are still strong, valuations are very attractive, balance sheets are very clean. From my perspective, the key feature of the risk-off environment in April and March has been markets have pulled lower, but bond yields have not responded, especially in the US. Bond yields have stayed high. That has protected the financials. And ultimately, the biggest question that we were discussing in the US is, will rates fail to provide a hedge in a risk-off environment? And I'm saying that might be the case for as long as the macro data is still holding up, which is the case now. Once the macro data weakens, especially in the labor market, central banks will turn more dovish, bond yields are going to decline, and financials will look a lot less attractive than they do now.
If the euro keeps appreciating, say we go to 120, say we go to 125, are we going to be in a situation where the European economy staggers and stalls, and that's bad for European investors, but for US investors, the currency will be a big enough compensation to take out the risk that we are seeing domestically as a result of that stronger euro? Could we find ourselves in a situation where a lot of the big gains we've seen so far this year unwind, but US investors still make money? I'm just curious, all those conversations that you've had with the US investors, what are they thinking about the European market looks like for the rest of this year?
So as I said, we are neutral, but we found a lot of optimism on the relative trade. And I would say the prevailing sentiment that we found in New York is people were enormously bearish on US assets. So the idea of the rise of the US-specific risk premium, which we've seen in the drop in the dollar, the underperformance of treasuries, the underperformance of US stocks, the relative underperformance of US credit, that was a very dominant theme that investors were saying, look, foreigners have been piling into dollar assets for years. Now they've been given very strong reasons not to do so any longer. And so there was a lot of bearishness on US assets. And what we are effectively saying, I'm very happy whenever there's a strong consensus to take the other leg of this. The dollar is already trading at a very large discount relative to its fair value implied by rate differentials because you've done some very unwise policies. If you stop doing that, that discount could very easily stabilize. For treasuries, as I said, they will easily perform once you see the cracks in the labor market. And on the relative performance of European versus US equities in local currency terms, there's a lot of good news priced already into Europe. I agree with you. If they perform in line and the euro appreciates a little bit, then maybe they outperform from a dollar investor perspective. But given how much the dollar has already dropped, I would be very surprised if there's a lot more juice in that particular dynamic.
So let's talk about equities as an asset class as a whole, as opposed to kind of the regional division of it. There's an argument here that equities will continue to rally because there's still excess liquidity in the system, and that's a function of the kind of the post-COVID stimulus, but also American stimulus checks and savings that haven't fully hit the economy and the markets from that perspective. we haven't seen cracks yet, to your point, in the macro data, but also in these markets. Nothing has failed to function yet. Is liquidity enough to keep equities rallying?
Yeah. So I think that's really where the real battle of ideas starts. What is the best framework for thinking about the performance of equities? And whenever we do this exercise, we find the number one driver is global growth momentum. And that is why markets have been strong for 3 years, because we always expected growth momentum to weaken, and it never did. Our economists now in their projections see around 6 points downside for the global PMI. That's roughly global growth on a quarter-on-quarter annualized basis grinding to zero in the middle of the year. If growth slows, then earnings will be downgraded, and we're starting to see the first signs of that. And it's just never happened that you had a sharp growth slowdown without equities responding. And you say, so the main macro data hasn't cracked. So domestic demand in the US was still strong in Q1. We saw it yesterday. PMIs are still holding up. But look at consumer confidence. It's already consistent with us seeing negative payrolls over the coming months. Look at CapEx intentions. They have collapsed. Look at container traffic out of China into the US. It's down 50 to 60%. The first signs at the very front end of the data curve is starting to show there is a shock coming, and markets are saying, well, we haven't seen it yet, so we're not pricing at risk premium low. Once growth starts to crack in line with these early indications, there's a lot more widening of risk premium to come.
Can I ask you about investments and European companies investing, for example, in the United States? Politically, they might be motivated to come out with lines saying that they're going to invest over in the US, but there's a lot of volatility in policy in the United States. They might not know what they're investing into. We might see a global growth slowdown, as you suggest. How much do you attach to these commitments from European companies? Do you see investment holding up?
Yeah. So I would say for the performance we were basically interested in what happens over the next 6 to 9 months. It's not very relevant. It's not going to change the needle. And then if you ask, will the US administration, effectively, are they playing 4D chess? Will they be successful in bringing the companies in? All we're seeing for now on the domestic front is CapEx intentions collapsing because companies are facing very high uncertainty. And you say, broadly, the investment climate in the US seems to be deteriorating for now. And so, therefore, we see very little indications that that master plan is effectively playing out successfully.
Great to see you. Always a pleasure. It's nice to get a take on what US investors are feeling as well from a European perspective. Sebastian, nice to see you. Sebastian Rehler, European Equity Strategy Head, Bank of America Global Research. While we've been talking, there's been a few little interesting developments when it comes to what has been going on with the BOJ, which I think is probably worth paying attention to. The line crossed a little while ago, 805. Price goal timing delay doesn't mean delay in hikes. I'm just trying to understand exactly what this means and just trying to get a kind of read on what is happening with the with dollar yen, just to see if there's been any reaction in that. We're still at session highs, so the market is still taking this dovishly. That sounds slightly more hawkish than maybe...
Yeah, I could imagine another time where him saying, it's OK, we're going to stick to the timing of the hikes, regardless of all these other things we're saying about price goals being further out and growth being downgraded. You could see a time when that would have boosted the yen. It's just, this is a market that has convinced itself earlier on today that the BOJ was dovish and seems to have stuck with that view, despite that headline. And then it went red, and it still didn't do much to move the yen.
It's a credibility story at the end of the day, right? That Governor Ueda is saying, look, we can still be hawkish, we can still raise rates, we can still rebuild that purchasing power for the Japanese yen for consumers. But at the end of the day, if we are making real changes to the growth outlook, there's no believability. I'm having Chair Powell deja vu, honestly.
So if you think about this from a trading point of view, it is logical. Basically, what we've created is uncertainty here. So that I think is what is being priced in the market to the market this morning. He's creating a little bit of ambiguity. We don't really know what the narrative looks like. Maybe this sounds a little bit more hawkish, but the broader tone, to your point, is one of greater uncertainty in terms of the outlook from the BOJ. Are we not going to see rate hikes coming through? I think at the margin, therefore, you've just got to take a little bit out of the trade, and that's exactly what the market is doing this morning.
Yeah, if you were a certain level at a certain level of certainty beforehand on your rate hike path, then if uncertainty has increased broadly, then maybe you are a little less certain about your rate hikes. But anyway, we'll see. The yen may be turning slightly now, but really not by much, down by 1% against the US dollar. Coming up, rockets, electric cars, and now a new city. Elon Musk's plans in Texas are the subject of today's Big Take story. We'll cover that and other news flow surrounding Elon Musk. This is Bloomberg. Welcome back to the opening trade. We are 18 minutes into a much truncated European session in the sense of the number of participants at play here. We only have London for you, basically. Many of the other markets in Europe are closed because it is May Day. We don't get our holiday until next Monday. And with that said, the FTSE isn't giving us very much. The FTSE is entirely flat. Rolls-Royce is in focus, of course, and that is on the upside, up by 3%. Shell and BP, actually, the biggest fallers from a points perspective, and that reflects the weakness we are seeing in the oil price. That was something of a trend of yesterday as well, that weakness of the oil price. So 66 on Brent, now down at 57 on WTI.
So Airbus is not trading today. So we don't have a reaction to what it told us in terms of its Q1 numbers. What it did tell us, what Guillaume Faury, the CEO, did tell us yesterday, basically was that Airbus will not cover the cost of tariffs on planes imported by US airlines. In theory, this is going to set up a clash with the carriers. There are some very creative things going on, and this is a story that we've watched in the past as well. Guillaume Faury is saying that customers are basically Airbus is not going to pay the tariffs, that customers are going to have to do it. He's saying it's basically on them. I'm not sure this is... So Delta, so Ed Bastian, creative guy, runs Delta. What they do is they fly their aircraft from Toulouse, the delivery centre we just saw there. They fly them to Asia, and then they fly them to the United States.
Yes.
And by flying them to Asia, they become second-hand aeroplanes.
But President Trump will see that. These are big things.
It's
hard to hide an aircraft. They have caution. I'm just saying that the administration has said, don't try and get creative to get around these tariffs.
I appreciate that, but there is probably some degree of... You need this to happen. There is also a certain pragmatism beginning to creep into the debate as well. So it's going to be, they tried this in the past and it worked. Will it happen again? I think will be something that we will watch very, very carefully. So as a result of which, basically, Faury stuck to guidance for Airbus, which is interesting, but he basically said, I'm excluding tariffs from this. Which, it's like the Volkswagen guidance. I just wonder how useful this really is. Basically, basically what he's saying is we don't know. We don't know what effect this is going to have. He did say it adds to complexity. They're still facing all kinds of supply chain issues as well. They were facing supply chain issues before. That's only going to get worse going forward from here. So there's huge amounts of uncertainty.
I believe we were still dealing with the supply chain issues that were
come from COVID.
From COVID and the pandemic. I mean, that's quite incredible, isn't it? For many sectors, they were back to normal, but for the aviation sector, it seemed difficult to achieve.
I think certain amount of it's COVID, certain amount of it's just engineering issues. The engine manufacturers, particularly for the narrow-body aircraft at Airbus, have had some fairly big issues. CFM and Pratt have both had big issues. So they've been building what they call gliders because they don't have the engines they necessarily need, and they've been pushing them out to customers as well.
Let's take a short trip from Toulouse to Spain, over the border, over the Pyrenees. Chrissy, we had news out of Spanish banking.
We did. We got the approval that BBVA was waiting for when it comes to their unsolicited offer, which is a delicate way of saying hostile takeover for Banco Sabadell. This is a 13 billion euro deal. This is enormous in the kind of background of the banking consolidation we're seeing around Europe. The reason I think this is so important, and this has been a back and forth for about a year now, so a lot of pushback from the Spanish government. We're still waiting to get the full sign-off from the Spanish government, the regulatory authority giving the green light, though. So we're still a little bit about 45, 60 days away from getting kind of the full beginning of this merger. But one of the key remedies of this kind of approval was that some of the bank closures that BBVA wanted to do, specifically in Catalonia, which is where Banco Sabadell primarily operates, that's where they have to limit some of that. It brings up the question of how much kind of cost savings, which was part of the initial pitch, actually comes to fruition. This is also accompanied, by the way, because of this domestic consolidation, that if it passes through, there's a question here of whether the sentiment out of Spain can then affect the sentiment across Europe and open the gates to a wave of kind of deal approvals. We saw this with UniCredit and Banco BPM, the golden power out of Italy. But if this comes through, and again, we are still waiting for the others, this would be the largest continental European banking deal since UniCredit's acquisition of HVB. That's a big deal.
But it's a domestic deal.
Sure.
The whole idea of Europe at the moment is that we want to do cross-border deals. Do we want to get a bigger banking union? That we want to get commonality around Europe in terms of the banks and the rules. This speaks against that, not for that.
But if you can't even get a domestic deal, how can you even talk about an intercontinental deal?
But it looks like we are going to get a domestic deal. Isn't this only going to encourage further domestic deals?
Potential. I mean, that is the concern of the Spanish government. That's the critique here, that if you have more consolidation at the end of the day, then they have more control over the consumer lending rates. It's actually ending up painful for the consumer. But this is a left-leaning government that's having that view.
Let's move on to the auto sector because we have had some news flow though, and some interesting dynamics around Tesla. Let's go there next. Tesla's chair has strongly denied a newspaper report the board was looking to replace CEO Elon Musk, saying directors are, quote, highly confident in his ability. Musk is also the focus of today's Bloomberg Big Take story. So good job we've got Craig Trudell with us, our global autos editor, to delve into all of this. So we saw this story, Craig, overnight from other media, not our reporting, but suggesting that the board was looking at other candidates for Elon Musk. And then we got a really strong denial from Tesla's management saying that that's not true. Where does that leave the management of Tesla, do we think?
I think there's obviously this still raises a lot of questions. I think the Wall Street Journal's report on this was pretty carefully worded in that they acknowledge it was unclear whether this search was ongoing. They worded it in a way to allude to the idea that search firms had been contacted. The board and Musk are saying that they denied this to the Journal before the story was published, and that wasn't included in the story, and are really sort of criticizing it as a result of that. I do think, though, when we sort of take a step back and think about where this company is and just how challenged it is because of what Musk has been doing to the company, you have this real bind where if you take him out of the picture, what does that do to the value of the company, given there's such a huge premium on this stock as a result of his affiliation, and yet it doesn't seem that he's fully engaged. I think even he acknowledged that last week when he talked about my time with Doge is going to significantly reduce, and I'm going to allocate more time to Tesla.
Starbase Texas. Sounds like, I have to say, it sounds quite cool. Does it come with a big Musk statue? Just talk me through the big take this morning.
You can see, actually, indeed, there is a statue of Musk's face. I'm reminded, a few years back, Musk, on one of his many appearances on Joe Rogan's podcast, he talked about how he was going to sell all of his homes because he referred to them as attack vectors, that, people were going to be critical of him accumulating all this wealth and having these many homes. Apparently, he's less concerned about that now because he now wants to have his own city, his own company town, which is sort of feels like from another time. This is a small village on the very southern tip of Texas called Boca Chica. It's already seen this incredible transformation because SpaceX has just completely transformed it. And what he wants is to be able to launch rocket after rocket in short succession, not really have to answer to anybody in that process. This won't necessarily, remove any regulation or any people telling him what to do, but it will, make things, I think, grease the skids for him.
Craig Trudell, Bloomberg's global auditor, walking us through some of the car stories in the latest 24 hours. Coming up, we're going to dive into the latest out of the BOJ. Stick with us. This is Bloomberg.
Welcome back to the opening trade, 8:30 here in London. And London is pretty much all we've got in terms of the European equity markets this morning. And that's pretty flat. The FTSE 100 is flat. We do have plenty of news flow coming to us, though, from Tokyo. The Japanese markets are open, and Governor Ueda at the BOJ is still busy giving his press conference. Must be coming to a close now. It's been an hour. We did get a red headline. Didn't seem to change the direction of the yen too much, maybe at the margin. But the BOJ's Ueda did say that the price goal timing delay doesn't mean a delay in hikes. So this goes along with the fairly dovish messaging we've had from the BOJ, bringing down their growth forecasts and talking about getting to their price goals a little bit later. So taking out some of the urgency around the hike conversation, you would have thought. But then the other part of that headline saying that doesn't mean that there is going to therefore be a delay in hikes. Well, let's get an expert view on what's going on at the BOJ. Yusuke Miyari joins us, G10 FX strategist from Nomura, and can give us his perspective. Yusuke, very nice to have you with us in studio. So we've seen the yen tracking lower almost continuously since the BOJ statement earlier on, kind of ignoring some of the slightly more hawkish lines coming out of Ueda, maybe. Not that hawkish, perhaps. But what do you take away from the BOJ in its entirety today? Are we still talking about a BOJ that is going to hike from here?
Well, in short, today, Governor Ueda was dovish, but still the path of the rate hike is still to the upside, and BOJ is still maintaining its rate hiking bias. But I think the key point today was that the BOJ has somewhat lost confidence in terms of like when it's going to hike, as well as how high can it's going to hike. So back in March, BOJ was more focused on domestic inflation situation, like food prices, other services inflation. But now it has more importance, placing more importance on international trade policies.
And they're talking about all of the uncertainties that exist in the global economy. And then close to home for Japan, huge uncertainty around the trading relationship with the US because that trade negotiation is going to restart today. The BOJ can't have much certainty about rate hikes, can they, given all of that?
No, to be honest, Japanese government is still trying to understand what the U.S. Trump administration wants from Japan, and Japan is trying to make some concessions at the trade negotiation deal today. But as you said, as we don't know what the end game will be, BOJ cannot be even more confident before we get some kind of a deal. Governor Ueda has tried to balance his comments by saying that BOJ can hike even though Japan's inflation doesn't reach 2% yet, but still, he's less confident than he was in March.
In terms of, so if I take Trump out and tariffs out of the picture, would there have been a BOJ hike this month? Would there have been a BOJ hike next month? Is the underlying disposition of the BOJ at this point to hike? Does it in its bones want to hike at this point?
So if you focus on domestic factors, then it wasn't this time's meeting, but like next meeting or a meeting in July was definitely a possibility for the BOJ to hike. Because if you see the services inflation in Japan, especially rent inflation in Tokyo, this has started to rise. And this was so low over the past 30 years or so, but it has started to rise. So price-setting mechanism is changing.
Does that translate into... The one thing he's flagging this morning is we're not seeing a big translation into service sector inflation at this point.
Well, I think he's trying to balance the situation. So he's more talking about the outlook rather than like what's currently going on. And he's seeing that food inflation will eventually go lower. So there will be a bumpy road in terms of like inflation going to 2%. But he still sees that 2% is happening, and that's a goal.
When you talk about kind of the outside effects that affect the yen specifically, it used to be oil prices. It was such an easy read-through into kind of the import prices that Japan was coming from or was dealing with. Is there a change in kind of what that catalyst or that key driver is in terms of external factors? If not oil, what is it?
Well, it's dollar in general, maybe, I would say. So global capital these days are still trying to find where to park their money. Over the past 10 years or even more than 10 years, people were kind of like happy, satisfied with parking their money in the U.S., but now they're thinking about like where to put if this de-dollarization narrative continues to go on. So, oil price is still one factor to consider dollar yen, as well as the BOJ's policy rate forecast, because, BOJ clearly mentioned that oil price lower is one of the factors that lowered their inflation forecast. But other than oil prices, I think what ultimately drives the dollar yen at this point is where the dollar is going.
What is the relative trade, though, when it comes to, we're talking about trade flows, which Anna had mentioned at the beginning, that's part of the fiscal conversation. What is the relative trade between the South Korean won, the Chinese yuan, and the Japanese yen when all three countries are engaged in the United States with trade talks right now?
Well, I would say in terms of the currency, yen is still working as a safe haven currency, and is, along with South Korea, it is still leading in terms of the trade talks with the U.S. So, I think the good example was in 2018 when dollar CNA, dollar CNY went up, but dollar yen eventually went down. And that was when the Fed was, in 2019, the Fed was cutting. That caused the dollar yen to go lower. So I think yen still works as a safe haven currency, and that is some kind of a difference between Korean won and Chinese yuan.
Okay, so the yen as a haven. Talk to me about where, and you touched on this a moment ago about the de-dollarization conversation. What you said in your notes ahead of our chat today that you don't see much Japanese foreign asset selling. Talk us through some of the detail there, because as soon as the dollar dropped quite so much and treasuries looked quite so challenged, a lot of people were saying, will Japan start selling? Will China start selling their holdings of treasuries? What are you seeing?
So in terms of the public data, we aren't, as you said, we aren't seeing any like Japanese investors like massively net selling U.S. treasuries or like foreign assets. I think Japanese investors are still struggling to understand where the currency would go. I think dollar yen at 140 was a key level for Japanese investors. It was about to reach, but when it touches 140, it just rebounds. If it breaches that level, I think Japanese lifers and other investors will start putting on FX hedges. But now that dollar yen is back to 145, if you have a higher return outside Japan, and if the currency's dollar yen is going up, then why invest in Japan? Why not invest in like outside assets? So I think that's kind of like the thinking is happening.
What is your perception from the conversations you have with people in Tokyo about when they think a trade deal with the United States will come? Like, what kind of timeline are we thinking about? You've got various officials in the US talking about or sounding like they think these deals are coming soon. Is that the perception in Tokyo, do you think?
Well, it's kind of tricky. I mean, it could come before the 90-day reprieve, but at the same time, we need to consider about the election in Japan. We have a upper house election in July, and we don't know who's the next government, who's the leader of the Japanese government will be based on, depending on that election situation. So Japan may not want to, like, fully advance its trade negotiation before what's going to happen in the future.
What is the perception of what America wants? So what does a trade deal look like?
Well, what Trump president himself wants is to just reduce the trade deficit between Japan, right? But can it really achieve that goal? It's pretty impossible in this like globalization situation. So I think he wants some kind of a deal that Japan and U.S. are having like a win-win relationship. So
what does that look like?
Well, one that the market is speculating is about the currency, right? So weaker dollar, stronger yen, or like higher yen rates. That could be one option, but it looks like it's not happening immediately based on the Ministry of Finance comments.
Yes. Yeah. What role is the yen going to play in this conversation? Because, you point out that maybe the trade deal might look like more agricultural imports into Japan from the US, more LNG imports from the US into Japan, maybe some US vehicles. I mean, that's everything I read about that just gets more and more complicated. But what about the role that the yen plays then? Is it still quite difficult to assess?
Well, it's difficult to assess for sure, not just about yen, but like any other currencies. But I think yen, as we discussed here, is likely to work as a safe haven currency.
Yeah, I just mean because the Trump administration has been quite vocal on the weakness of the currency in recent years. And so you imagine that if President Trump is in the room, and he seemed to be for some of these other trade conversations, if he's in the room, surely he will want that to be part of the conversation.
Exactly. But so that's why everyone was like focusing on the BOJ today, but it looks like the governor is dovish. So even though that kind of the discussion is ongoing in the White House.
This is the really tricky thing. In some ways, if you want a deal, you need a stronger currency. But the governor's not pointing us in that direction. Is the governor is this a problem for getting a deal done? Is what has just happened with the BOJ going to make it even harder to get a deal done with America?
Well, BOJ is a very tricky situation. BOJ's mandate is not to control the currency. It's tries to maintain the price stability, right? So if the BOJ does it too much, then it could maybe, appreciate the currency, but it could, deteriorate the economy and prices. So I think the BOJ is trying to balance things and be flexible, can be nimble. So that kind of balanced approach was done today.
Okay. Maybe trying to stay out of things a little bit as well, but maybe not exactly having the effect that was maybe desired by certain others. Yusi Miyari, thank you very much indeed. G10 FX strategist joining us from Nomura. What are we going to be talking about next? The day is not done. In fact, it's just getting going. Europe's largely asleep, still enjoying the holiday today. Apple and Amazon are going to be reporting results later today. The tech giants responding, of course, to Trump's tariff turbulence. That's all coming up next. This is Bloomberg.
This is the opening trade. We only have London trade for you this morning here in Europe. We are flat, basically, on this market. The rest of Europe is closed for a bank holiday. It is the 1st of May. Labour Day in many places. We take ours on Monday, so that's why we're all here. Rolls-Royce is one of the better performing stocks this morning, up by 2.4%. And from a points perspective, that's adding something to the FTSE 100, along with HSBC having another decent day. Shell, BP, those are points-wise drags on the FTSE 100. We see the oil price a little under pressure, now down by more than 1% actually on WTI. So quickly, that's, we've got the London market and we will have US trading later on.
We will have US trading. So I think
we had Japan.
And we had Japan. Europe is taking a siesta, if we will, today, and I believe tomorrow as well. But don't worry, we've got plenty of U.S. data, as Anna was pointing out, to keep us company. At about 1:30 p.m. UK time, those U.S. jobless claims are going to be hitting the wire. 90 minutes later, ISM manufacturing data coming out of the States as well. But I think the highlight might just be Amazon and Apple? Do they send a different tone than what we got out of Microsoft and Meta? Charlie Wells joins us around the table with all the answers, I imagine. Walk us through it. Or is all the good stuff in the rearview mirror now?
I mean, look, Apple's going to have a difficult day, I think, because there have been a lot of questions about AI. I think we've been talking a lot about trade. But remember, Apple has been struggling with AI. They've had a rejigger inside the company that we've been reporting on. But I also just want to bring up this fact that, Siri was released in 2010. That was 15 years ago. If you have a 15-year-old who can't really talk very well, doesn't really listen, you've got trouble on your hands. And Apple has trouble on their hands.
What's that like, Guy?
Teenage boys, I can tell.
We're quite qualified to talk about that around this desk.
I'm not sure I can blame Siri. I think I can just blame being a teenager for the above. Though it's interesting when teenagers try and talk to AI, that AI slightly struggles to understand them, which I think is fascinating.
You got to get on board with the slang.
They need retraining. Well, precisely. The language is completely different and seems to change on a daily basis.
Yeah.
OK, let's talk about Amazon. Amazon has a retail story that I think is going to be fascinating to watch out for, because you are going to see a tariff effect. Clearly, we saw all the hullabaloo about kind of whether or not we're going to see tariffs being being put on the prices. What are we going to learn today, and which bit of the business are we going to focus on? Because cloud was good from Microsoft yesterday.
Yeah.
Is it going to be good for Amazon? But do I focus on the retail side?
Well, yeah, I think, Guy, you're getting at this really important point. That's like, yeah, we've been talking about trade, but think about tech, too. Don't forget that's been under pressure. And there are some expectations that cloud growth at Amazon, which is so crucial for their profit, that could slow down. And remember, this is a space, cloud, you think it's so futuristic, there's so many opportunities there. It's a maturing market. There's more competitors. We just heard about Microsoft's growth. I mean, this is competitive. This eats into what Amazon is trying to do. And so I think, some of that slowdown could have a negative kind of narrative shift for them.
Can I just say that one thing I think we have missed overnight, actually, is the Qualcomm numbers, which in some ways were quite good, but the stock got bashed on the tariff news, which I think takes us nicely into what we are going to learn tonight. Yesterday, in some ways, you could argue, was the good news from tech. We're going to potentially get some bad news, and I think Qualcomm maybe is a kind of lead indicator on that. Val's here as well to talk us through this. So we've had the good news, and everybody's very happy about the good news. Do we now get the bad news? And is that kind of the next part of this trade?
Yeah, I think that's what investors are asking. This morning, are stocks going to continue this 7-day streak? Are we going to make it 8, perhaps 9? But I think there is risks ahead, as you guys were mentioning. Both these tech earnings tonight, these names have heavy reliance on China. Both Apple and Amazon, supply chain very intertwined with China. Will we maybe walk away with this as seeing more of a warning about tariffs actually hurting these businesses, about struggling, to change their supply chain in the manner that Trump and the speed that Trump wants them to? Are we going to see kind of that negative around that? Remember, we also have ISM manufacturing today expected to fall farther into contraction. These two things combined, I think, might resurface some worries on tariffs amidst this equity market bullish.
Right, so we're waiting for the tech earnings, and as we said, that pivots to a slightly different angle on tech overnight or during today's session. But then thinking about the overall sentiment around trade, Val, this is interesting because I think the market seems a little confused what to make of some of the latest China lines. I mean, just earlier this week we were hearing from Scott Bessent, who did say the US has put aside China conversations. We're focusing on India and all these other ones, and he name-checked India, suggesting that one could come soon, and we know that Japan is ongoing, of course. Then we get from CCTV in China some statements that the US has reached out to China, and you could say, oh, is that the US blinking? Are we going to see some further turnaround in US trade policy here? But then Jameson Greer, trade representative, saying there's no official talks yet with China. I don't know, all of this doesn't necessarily add to our clarity as to just how quickly we're going to get the two largest economies in the world around a table talking seriously about trade.
Yeah, exactly. But I do think maybe there is a speculation that the Trump administration wants to get all the other countries dealt with, because in some way maybe they want to use those negotiations with other countries in a way to isolate China. And perhaps, that's their focus right now. We want to get this done with Japan. We want to get it done with South Korea, get it done with India, so that maybe we can convince them. Maybe that's something they want from these negotiations in order to isolate China alone. So maybe that's the speculation of why they don't want to move too fast. They are not in a rush with these China negotiations because they want to get their allies on their side.
Well, Charlie, marry that China sentiment with what we might get out of the tech space. And you kind of talked about this earlier as well at the wall. Microsoft does have exposure to China. Apple famously has exposure to China. So does Amazon. Is there a China discount for some of these companies?
I would say there's a China disconnect in that the China story needs more nuance right now. So you think about Amazon reporting later today. It's not just stuff coming out of China that's subject to a lot of uncertainty and turbulence. It's services, right? Amazon has these Chinese retailers who rely on their logistics services, who rely on that high-margin advertising. That's part of the China narrative that needs a reconstruction. And I think if you want to think about Apple, look, there have been reports that they're trying to move a lot of their iPhone production to India, and that's great, right? You want to diversify the supply chain. But remember back in Trump 1.0 when a lot of companies, not just in tech, but across the board, moved to Vietnam, and then they were suddenly shocked about these Vietnam tariffs. So I think just thinking that kind of diversifying out of China is going to be a safe bet, I think that needs a little bit of tires kicked.
Val, in terms of the optimism around all of this, we have seen a rally.
Dent my optimism.
I'm desperately trying to dent your optimism. We're going into May. I have what are people saying about the seasonality? Normally at this time of the year, you are starting to maybe fade some of the moves that we've seen. Is there a belief that this is just a tactical short-term rally, that this rally that we've seen over the last few days doesn't really signal anything about underlying sentiment? Do I need to separate out positioning at this point from actual kind of views on where ultimately we are going? Is this just a positioning rally?
Well, there is that famous phrase of sell in May and go away, but I would argue May is going to be a pivotal month for where we could possibly see this air pocket of hard data that the U.S. economy might run into. So I do think that maybe seasonalities, if you focus a bit on that, that's really missing the point that we could be at risk of seeing, the hard data begin to crumble in the next few weeks. Now, I'm not in the case that we are going to see that. I think it might actually be later in the summer, maybe not until June, until we start seeing some real weakening of the labor market. If it was going to come there, it would probably come later. I think that the data yesterday that we saw, the GDP data, the inventories have been buffered. People have front-run these tariffs. It does seem like these corporates are sitting on a lot of inventory that they can weed their way through and maybe push that supply shock afterwards. But all in all, the next few weeks, could be pivotal for the U.S. So in some ways, I think looking at seasonality is kind of missing the point.
Cool.
Absolutely, one that we're going to keep an eye on. I think the sell in May thing is interesting because it's only day one. People sell in May at the end of May after May's had a good month.
Well, April was really long, so we're just bracing for that.
This is true. Charlie Wells, Valerie Teitel walking us through some of the key drivers of this market this morning. But I think, Anna, we have to go back to the geopolitics here, and that, of course, brings us to Ukraine.
Yeah, absolutely. Let's go back to that story because this is something we've watched develop overnight and still leaves the path a little uncertain from here. So let's look ahead. The US and Ukraine have signed a deal over access to the nation's mineral resources. What does this mean for broader peace efforts, though, as they remain elusive? Bloomberg's Greg Sullivan joins us. Let's do some detail on the deal then, Greg. What do we know about what has been signed?
Well, the details of this deal have changed as these contentious negotiations have played out. You'll remember that President Volodymyr Zelensky originally went to Washington to sign the deal, and that was when that disastrous White House encounter occurred. So now we have a deal that has been signed, and it basically gives the U.S. priority access to investment projects in Ukraine in the area of natural resources. We're talking about oil and gas development, potentially minerals like aluminum and graphite, and basically the proceeds from these licenses, the profits would go into a jointly managed reconstruction fund, and the U.S. would have priority access to those profits. Now, the U.S. says that is because it will pay for future aid to Ukraine. It's worth noting that one thing that was dropped from this agreement was the U.S. insistence that Ukraine pay for past aid that has already been delivered. Another thing that is not in this deal are security guarantees for Ukraine should any final peace deal be reached. And that's been a crucial and key issue in these ongoing talks. Another big question that remains, what kind of military assistance will the U.S. be willing to provide Ukraine going forward? The weapons and ammunition they've come to rely on, the intelligence sharing, that's also not clear coming out of this deal.
That all sounds really important to me. All the things you just laid out sound pretty critical to getting a deal across the line when it comes to a ceasefire. How big is the overlap between what has just been signed and a potential set of ceasefire talks? What is how much of an overlap on the Venn diagram do we see between these two ongoing parallel lines that we are watching so carefully when it comes to ultimately a peace deal being signed in Ukraine?
Well, on the one hand, this definitely allows Kyiv to keep President Donald Trump engaged. There have been real fears that he could pull back. We've heard from senior administration officials that they're ready to walk away. We also know that U.S. proposals have been heavily weighted towards Moscow, favorable towards the Kremlin's position. And in a lot of ways, this is an effort by Ukraine to keep the U.S. and President Donald Trump on their side and make sure that any final deal does not get weighted too heavily towards Moscow. But on the other hand, even with Special Envoy Steve Witkoff having just made his 4th trip to meet with Putin in Moscow last week, there's still no signs of a deal coming out. And in many ways, Russia has actually hardened their position in these negotiations. So the talks do not appear to be making much progress at the moment, but this should provide Kyiv with some assurances that they've at least will be able to keep Donald Trump engaged in the process, given this new deal that he signed with Ukraine.
OK, Greg, we're going to leave it there. Great stuff. Thank you very much indeed. Greg Sullivan updating us on the latest surrounding the deal that has been signed on resources in Ukraine. We now wait and watch and see what happens exactly when it comes to a peace deal. And you wonder whether European equities will get a big boost off that. I was raising that point earlier, because we don't know yet today whether there is some sort of premium that gets attached as a result of this. I would imagine when we do get a deal signed, if we get a deal signed, hopefully we will get a deal signed, that there would be an effect on European equities.
Yes. And
European assets broadly.
And it would be interesting to untangle, expectations for defence as a result of that, because the defence spending is a wider story now than just spending on Ukraine's defence. It's much wider. It reflects the Trump administration's policy towards Europe. So we'll watch to see what happens on that front. So we're not going to get any movement on that today, not from European perspective, European equity markets. We are getting data, as the United States. Val nodded to this a little earlier, but worth saying again, we get that ISM manufacturing, which had the prices paid element, which has been ticking up in recent months, hasn't it?
The digestibility of some of these kind of inflationary impulses that you've seen from consumers, but also from corporates in the United States, is the core of the bull case for the U.S. Basically, the folks that are not in Sebastian Radler's camp, they're saying that the people who can weather this are ultimately based in the United States. At least that's one bull case that you're hearing. Plenty of people are saying that about Europe as well. Yep. Do we see that those cracks start to show up in the data? And I think some of the data points today maybe early signs of that. That
wraps things up for this show. Enjoy May Day. If you are taking the day off, if you are trading the FTSE 100, it's not doing very much. Maybe you look to the US for a little bit more excitement later on in the session. That wraps up the opening trade. The Pulse is up next. This is Bloomberg.